Today, Bitcoin and Ether rise after the Fed keeps interest rates unchanged. Arkansas state lawmakers pass new rules for crypto miners. And New Form Capital's Alex Marinier breaks down why traditional institutions are now more open to blockchain investments. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Cryptocurrencies recovering some of their losses after Federal Reserve Chair Jerome Powell said the central bank's next move is unlikely to be a rate hike. Bitcoin rose about 4% to $59,200 by noon Eastern. Ether advanced more than 3% to $29.90, and Solana jumped 12% to trade at $139. Okay, let's talk about some of the top stories. Bitcoin mining firm Stronghold Digital announced first quarter earnings and said it's exploring a possible sale. The company reported $27.5 million in revenue last quarter, up nearly 60% year over year, plus $5.8 million in net income. But in that same earnings release, Stronghold said it had started a formal strategic review process using outside advisors. It said it's considering alternatives to maximize shareholder value, and that includes a sale of all or part of the company's assets. Greg Beard, the chairman and CEO of Stronghold, said the company has observed what we believe to be a valuation dislocation when comparing Stronghold's market value to valuations of public Bitcoin mining peers, merchant power companies, and data center and power generation assets trading in the market. Shares were down about 2% at noon. The news, of course, comes after the Bitcoin halving, which slashed miner revenue and was expected to lead to consolidation in the Bitcoin mining pool. Next, and sticking with Bitcoin mining, Arkansas's state legislature has passed new rules reining in crypto miners. Lawmakers passed two bills on Wednesday. Senate Bill 78 creates requirements for miners to reduce noise coming from their facilities. That's been a growing complaint from Arkansas residents who have sued over the fan noise coming from miners within the state. Meanwhile, Senate Bill 79 adds permitting requirements and regulations for digital asset miners by amending Arkansas's Data Centers Act of 2023. That law sought to limit regulation of miners at the local level. Lawmakers later said that they didn't have all the information about that 2023 bill when they passed it. Now, these latest bills head to Governor Sarah Huckabee Sanders' desk. And finally, PayPal is enabling customers of the Web3 exchange MoonPay to buy crypto through PayPal. The two companies announced today that MoonPay users now have the ability to buy and sell more than 110 tokens with PayPal, whereas other integrations only allow users to buy its stablecoin PayPal USD or ETH using their PayPal account. MoonPay says the partnership will help customers who struggle to buy crypto with debit cards due to certain bank restrictions. PayPal began offering crypto services back in 2020, and just this past summer, it announced its own dollar-backed stablecoin, the first for a major U.S. financial institution. All right, turning to venture capital investments for our main story. Crypto World's Talia Kaplan spoke with Alex Marinier, founder and general partner at New Form Capital, an early-stage VC firm, about trends to watch in the fintech and blockchain space. He explains why more traditional finance institutions are now moving towards blockchain investments.
You believe there's a, quote, seismic shift happening on Wall Street with traditional institutions that have historically ignored blockchain investments now seriously looking at the sector. So you're the founder and general partner of New Form Capital, a blockchain-focused VC firm. So what have you been noticing when it comes to Wall Street's appetite for blockchain technology, and what do you attribute the shift in sentiment to? What are some of the catalysts? Do they include the approval of spot Bitcoin ETFs here in the US earlier this year?
Yeah, that's absolutely been the biggest catalyst so far this year in both the appreciation of crypto prices and the kind of re-engagement that we're seeing amongst large financial asset firms on Wall Street. Look, it's no secret that the blockchain space has had a rough go in 2022 with the market correction and the frauds that came to light during that correction. Mostly the media has been covering the space in a negative light, covering the frauds and the more speculative nature in the space. But BlackRock kind of spearheading this new ETF push and unveiling a number of other tokenized assets has really kind of recentered the conversation around a new generation of digital financial assets that are running on tokenized rails. So, when Larry Fink, who runs the world's largest asset manager, says at Davos that, their grand plan is to tokenize $10 trillion of their AUM on tokenized rails, people tend to listen. So I think with the price appreciation, with kind of leaving crypto winter and a lot of the negative press behind us, you're starting to see sophisticated investors revisit the space and really kind of test blockchain technology for its merits as it pertains to financial markets.
So, what are you noticing are some of the use cases and opportunities in the blockchain space for traditional institutions? What have they been most interested in recently?
So we just touched on Larry Fink, talking about how he's planning on tokenizing $10 trillion of their financial assets. Some viewers might be asking, what does tokenization mean? That's really just kind of the process of taking a more traditional financial asset and coming up with a digital representation of that asset that trades on-chain and enables a lot of the benefits of having an on-chain assets. Benefits that include 24/7 peer-to-peer transfers, built-in KYC and regulatory compliance, programmatic payments and dividends that you can build into these different blockchain-based securities. That's really kind of the interesting part to us, and we're investing in companies that are helping with that tokenization process. You also saw, another super large financial manager, Franklin Templeton, come out last week and mention that they're actually enabling peer-to-peer transfers for a tokenized money market fund they launched in 2021 on a public blockchain. And the hope is that, longer term, assets like that can be interoperable with the broader digital asset ecosystem. So another big kind of step in the right direction from large financial institutions. We also, just last week, saw an announcement from Stripe that they're enabling crypto payments in their product again. This is actually the second time that they've reintroduced it. The first go round, the tech was not quick enough. It wasn't cheap enough, but they're now finding that after 2 years, a lot of the scalability problems have been solved, and it's now cheaper and more pragmatic to enable USDC stablecoin payments in their product. So these are all, massive existing fintech firms and financial asset managers that are kind of announcing big products in the space, all kind of in this larger secular trend of blockchain coming into kind of the Wall Street lexicon.
Now, expanding on that, the Stripe announcement came 6 years after the payments firm dropped support for Bitcoin, citing the token's notoriety for volatile price swings and a lack of efficiency in making everyday transactions. Also in March, you noted this, BlackRock, the world's largest asset manager, jumped into the asset tokenization race, creating that new fund on the Ethereum network. So what do you make of these developments from traditional financial institution, and what's your outlook for the future of blockchain and finance?
Yeah, so I'll address, you brought up Stripe, so I'll address that first. Stripe, you mentioned that 6 years ago that they had kind of started, they tested the waters with Bitcoin payments, actually. They found that there wasn't a lot of demand for it, citing the volatility that's inherent in Bitcoin. It's also just a question that it was a little bit too early. Digital asset penetration was still in the single digits, whereas they're reaching higher now. The biggest thing is that they're now using USDC, or a stable coin that's pegged to the US dollar. So one, they're taking kind of the volatility out of the equation that's inherent with Bitcoin. But two, the tech has just gotten more scalable and cheaper to transact. So it makes it more pragmatic for the mainstream today. I will say that firms like BlackRock entering the fray is also massive, as it de-risks the space for other asset managers who look to the largest asset managers to see what they're doing. And again, I think we're going to see with this ETF launch that later this year, we'll see different advisors start to advise kind of a 1 to 5% digital asset allocation to their clients' portfolios, which I think is about right given the volatility inherent with the space. And this is all kind of part of a larger shift of crypto and digital assets moving from more of a kind of fringe asset class to entering kind of the mainstream financial portfolio, which is obviously big.
So the price of Bitcoin has been dropping this week, but in March, the cryptocurrency hit a new all-time high above $73,000. How has that played into VC interest in blockchain technology? In February, PitchBook released its fourth quarter update, revealing that the level of investment for crypto-related companies in the quarter climbed for the first time in nearly 2 years amid Bitcoin's stellar run. What do you think about the uptick in crypto VC funding, and what do you think caused that increase?
Yeah, so I've been investing in this space since 2016. There's a lot of inherent cyclicality that comes with investing in digital asset markets. That plays out both in public markets and private markets on the VC side. We work with a lot of our founders to create a plan to become capital efficient, to be able to survive both market booms and busts. Look, I think that we've come a long way in terms of the recovery of the space from the lows in November of 22 post FTX, where Bitcoin was trading around 16 grand. Now we're seeing it in the 50s, even after the recent consolidation. So, look, it's definitely a sign that we're moving kind of out of crypto winter into kind of the next phase of the expansion. This isn't our first rodeo, right? We've dealt with these boom and bust cycles before. We try and pay attention to longer, 10-year trends versus having to worry about kind of the daily fluctuations in the space. But you're right in that, that the price action tends to kind of lead private market valuations by about 6 months or so. So you're starting to see the reemergence of interest from more generalist VC funds that typically are fair weather investors. They tend to leave the space in crypto winters and tend to come back when the price action is going up and to the right.
Okay, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.